Hello friends, welcome back to another important video. Friends, with CAIIB examinations going on, I am back with this super important video for your forthcoming paper of banking regulations and banking laws. Friends, this is mostly a theoretical paper and thus it's very scoring. So try to cover as many marks as possible in this paper. Now you all know IRBF is focusing on case studies and conceptual questions from last few years. So it's very important for you that you also get conceptual clarity before you go to your examination. And to help you with that, this mock test contains only conceptual questions and case studies that have very high probability of coming in your forthcoming examination. Friends, before moving ahead, don't forget to subscribe this channel since this is the only channel that provides quality content. Also join our Facebook group, which is a group of like-minded and goal-oriented aspirants. Apart from this, I have a Telegram channel as well where I post lots of one-pagers, PDFs and daily important questions with respect to your examination. All the links to join are there in description to this video, so do join after you finish this mock test. So let's start with today's mock test. And the first question is: Anuradha was occupying the office of Women Director in a company, but due to her sudden death on 17th March 2024, the intermittent vacancy so occurred was required to be filled up at the earliest because she was the only woman director of the board. The next board meeting is scheduled on 25th June 2024. The vacancy of woman director must be filled latest by, and these options are given to you. Now friends, this is a very good conceptual question from the topic directors of your course curriculum. And this question is based on very important concept with respect to filling of intermittent vacancy of women director. The basic concept says that any intermittent vacancy of a woman director must be filled up by the board at the earliest but not later than immediate next board meeting or 3 months from the date of such vacancy, whichever is later. Now in our case, the next board meeting is 25th June. Now 3 months from the date of vacancy, that is date of sudden death of Miss Anuradha, is 16th June. And as you can see, later date out of 2 dates is 25th June. So vacancy must be filled latest by 25th June 2024. Thus the correct option for the given question is option A. The next case study is also from director's topic of your course curriculum, and the case goes like this. Goa Gaming Limited constituted its board with 12 directors, in which 2 directors are independent directors and 1 director is a nominee director. As per the provision of Section 152 of Companies Act 2013, the concept of retirement by rotation of rotational directors shall be applicable to public company. For Goa Gaming Limited, calculate the number of rotational directors which are liable to be retired by rotation. And these options are given to you. Now friends, this is an important conceptual question, and please remember that as per norms, at least 2/3 of the total number of directors are liable to retire by rotation. In case of Goa Gaming Limited, total number of directors who are holding their office is 12 directors. And please remember that independent director and nominee director are not counted in total number of directors. Thus 12 directors less 3 directors, that is 9 directors, shall be counted for total number of directors. So here directors liable for retirement by rotation will be 9 multiplied by 2 by 3, that is 6 directors. Thus the correct option for the given question is option B. Now friends, before moving ahead with the lecture, don't forget to get your CAIIB resources. These 4 books are 1000 series question banks of Advanced Bank Management, Bank Financial Management, Advanced Business and Financial Management, and lastly Banking Regulations and Business Laws. All these books comes with lots of conceptual questions, case studies and numericals. And also all numericals and case studies comes with detailed explanations. Moreover, these books comes with my full support. That means if you get any issue with any of the questions from the question bank, then you will get my priority reply. And then for optional papers, currently I am offering HRM and Rural Banking 1000 series question banks. All the links are there in description to this video, so always get updated books from the links given here. Next, let's move forward with our mock test. The next case study is: Miss Nikita Joshi is an air hostess with the Air France. She flies for 12 days in a month and thereafter takes a break of 18 days. During the break, she is accommodated in bays which is normally the city where the airline is headquartered, that is Paris in this case. However, for security considerations, she was based at Mumbai. During the financial year, she was accommodated at Mumbai for more than 182 days. What would be her residential status under FEMA? And these options are given to you. Friends, this case scenario belongs to chapter FEMA of your course curriculum. Now, as given in the question, that Ms. Nikita Joshi stayed in India at Mumbai base for more than 182 days in the preceding financial year. So, as per regular norms, she must be resident Indian. But here comes the twist. That is, though she stayed in Mumbai, she is employed in France, that is Paris. She has not come to India for employment, business or circumstances which indicate her intentions to stay for uncertain period. So please remember, under FEMA, such persons are not considered as Indian resident even if their stay exceeds 182 days in the preceding year. Ms. Nikita Joshi may have stayed in India for more than 182 days, but she can't be considered to be a person resident in India. So in our case study, she will be NRI, and hence the correct option is option B. But on the other hand, if she had been employed in Mumbai branch of Air France, then she will be considered a person resident in India. I hope you got the difference between the two. The real point is place of employment. In Nikita's case, place of employment was Paris, and that's why she will be treated as NRI irrespective of her stay in India. The next question is, with respect to Foreign Exchange Management Act, which of the given situations falls under current account transactions? Now, first situation is Mr. Subbu Peter, a resident in India, imports machinery from a vendor in Japan for installing in his factory. Then second situation is an Indian resident imports machinery from a vendor in Hanoi, Vietnam for installing in his factory on a credit period of 3 months. And last situation is an Indian resident transfers $1,000 to his NRI brother in Detroit, USA as a gift. The funds are sent from resident's Indian bank account to NRI brother's bank account in Detroit, USA. And these options are given to you. Now friends, this question also comes from FEMA chapter of your course curriculum. And to solve this, first of all, you need to know what current account transactions are. So please note, under FEMA, a current account transaction involves various payments related to foreign trade, business activities, services, and short-term banking. On the other hand, capital account transactions are those which alter the assets and liabilities, including contingent liability outside India of persons resident in India, or alter the assets or liabilities in India of the persons resident outside India. Now let's take each of these cases one by one and analyze them very carefully. In first case, an Indian resident, Mr. Subbu Peter, imports machinery from a vendor in Japan for installing in his factory. Now, as per FEMA, it doesn't alter or create any asset in India for the Japanese vendor. Also, it doesn't create any liability to the Japanese vendor for the Indian importer. Once the payment is made, the Indian resident or Japanese vendor neither owns or owes anything in other country. Hence, it is a current account transaction. Now for case 2, here an Indian resident imports machinery from a vendor in Hanoi, Vietnam for installing in his factory on a credit period of 3 months. Now under FEMA, it is a liability outside India. However, under definition of current account transactions, short-term banking and credit facilities in the ordinary course of business are considered as current account transactions. Hence, import of machinery on credit terms in this case is also a current account transaction. Then in last case, an Indian resident transfers $1,000 to his NRI brother in Detroit as a gift. Here the funds are sent from resident's Indian bank account to the NRI brother's bank account in USA. Now as per FEMA, once the gift is accepted by the NRI, no one owes anything to anyone in India or USA, and the transaction is over. Hence, this is also a case of current account transaction. So friends, as you can see, all the 3 cases belongs to current account transactions, and thus the correct option for the given question is option D. The next question is, Lawrence Old Age Home, Ernakulam, is a charitable organization, opened a current account with Kerala State Bank on 1st July 2020. This account was closed on 30th June 2024. referring to the obligations of banking companies under the Prevention of Money Laundering Act 2002, specify the period up to which the said bank has to maintain records relating to the account of Lawrence Old Age Home, Ernakulam. And these options are given to you. Friends, this is an important case scenario from the topic Prevention of Money Laundering Act. Now, please remember, as per Section 12 of PMLA Act, every banking company, financial institutions and intermediaries shall maintain the records referred to in Clause A, subsection 1 for a period of 5 years from the date of transaction between a client and the reporting entity. But this rule is applicable when account is open. Rule is a bit different when account is closed. So please note, in case where account is closed, bank needs to maintain record for a period of 5 years after the business relationship between the client and the reporting entity has ended or account has been closed or whichever is later. Now, as per the facts given in the question, Lawrence Old Age Home, a charitable organization, opened current account with Kerala State Bank on 1st July 2020 and closed the account on 30th June 2024. So, as per the provisions, Kerala State Bank shall maintain record of documents evidencing identity of its clients and beneficial owners as well as account files and business correspondence relating to its clients for a period of 5 years after the business relationship between a client and the reporting entity has ended or the account has been closed or whichever is later. So, accordingly, the Kerala State Bank has to maintain records relating to the account of Lawrence Old Age Home, Ernakulam till 30th June 2029. Thus, the correct option for the given question is option C. So friends, if you are loving this mock test and finding the content useful, then just write awesome content in the comment section. This will tell me that you are liking the content and I will definitely come up with another mock test before your examination. The next question is, Bhanushali Oil and Gas Limited, a corporate debtor, borrowed a loan of Rs 100 crores for its expansion project from State Bank of India, Bank of India and Punjab National Bank under the consortium arrangement in the proportion of 50%, 30% and 20% respectively. The corporate insolvency process has begun by the order of tribunal on an application made by the financial creditor. The Interim Insolvency Resolution Professional, that is IIRP, constituted a committee of creditors, that is COC in short, which noted that corporate financial debt owed by the corporate debtor is 500 crores in aggregate. Now, which of the following members of the consortium shall be the member of committee of creditors, that is COC? And these options are given to you. Now friends, this is an important case study and belongs to Insolvency and Bankruptcy Code topic of your course curriculum. Now, in case of joint financial creditors, as per the provision of Insolvency and Bankruptcy Code 2016, where the corporate debtor owes financial debts to two or more financial creditors as per the consortium or agreement, each such financial creditor shall be part of committee of creditors, that is COC. I hope by now you can easily guess the correct option for this part. Since Bhanushali Oil and Gas Limited owes debt to two or more financial creditors in our case, thus the correct option for the given question is option A. That is, members of COC will be State Bank of India and Punjab National Bank. Then there is another part of this case study, that is, what will be the voting share of the members in Committee of Creditors, that is COC, and these options are given to you. Now friends, here voting share of each bank in Committee of Creditors, that is COC, will be determined on the basis of financial debts owed to them. Voting share will be based on proportion of financial debt owed to each of financial creditors in relation to the financial debt owed by the corporate debtor. So on the basis of this provision, their voting share in COC shall be in proportion of the debts. That is in proportion of 50%, 30% and 20% respectively to the total debt of corporate debtor, that is loan amount of 100 crores under consortium arrangement. So as given in the question, IIRP noted that total financial debt is Rs 500 crores owed by Bhanushali Oil and Gas Limited. So voting shares of SBI, BOI and PNB in the given case will be, so for SBI it will be 50% multiplied by 100 divided by 500 crores is equal to 10%. Similarly for Bank of India it will be 6% and for PNB it will be 4% respectively. Thus the correct option for the given question is option D. The next question is, Dash is a web-based end-to-end workflow application through which RBI will monitor compliance requirements in a more focused manner with the objective of further improving the compliance culture in supervised entities, that is SES, like banks, NBFCs, etc. And these options are given to you. That is, first option is Saksham, second option is Daksh, third option is Drishti, and last option is Moksh. Friends, this question pertains to the topic regulation of banking business, that is from Module A. And this is actually a fact-based question, and the correct option for the given question is option B. That is, correct name of the application is Daksh. Now friends, this application will also enable seamless communication, inspection planning and execution, cyber incident reporting and analysis, and providing various MIS reports through a platform which enables anytime, anywhere secure access. Now the word Daksh basically means efficient and competent, reflecting the underlying capabilities of the application. So the correct option as far as this question is concerned is option B. The next question is, functions of non-banking financial companies are similar to banks. Which of the following is or are the correct differences of NBFCs from bank? And the first statement is, a NBFC cannot accept demand deposits. Then second option is, NBFCs do not take part in payment and settlement system. Then third statement is, DICGC does not support the NBFC deposit. And last statement is, NBFC cannot disburse small loans. And these options are given to you. Friends, this is a theoretical question based on your NBFC chapter of your course curriculum. I hope you all know what an NBFC is. An NBFC is basically engaged in the business of loans and advances, acquisition of shares, stocks or bonds or debentures or securities issued by government or local authority, or remarketable securities like leasing, hire purchase, insurance business or even chit business. In short, remember all these differences between an NBFC and a bank. So first of all, an NBFC cannot accept demand deposits, while a bank can accept demand deposits. Then second difference is, an NBFC is not a part of payment system and settlement. On the other hand, a bank is part of payment and settlement system. Then third, an NBFC cannot issue checks drawn on itself. On the other hand, a bank can issue checks drawn on itself. Then lastly, we have DICGC is not available for NBFC deposits, while DICGC is available for depositors of the bank. So I hope by now you can easily mark the correct option, that is option C. So here you can see the statement 4 is incorrect, that an NBFC cannot disburse small loans, while the fact of the matter is that NBFCs are designed basically for business of loans and advances only. The next question is, friends, this is a numerical from chapter NBFC of your course curriculum, and it goes like this. Calculate own funds of an NBFC based on the information given. Now paid up share capital is given as 150 lakhs, then free reserves are given as 250 lakhs, then compulsory convertible preference share, that is CCPS, are given as rupees 50 lakhs, and lastly revaluation reserve is given as 95 lakhs. And these options are given to you. Friends, please remember this chart for calculation of own funds of an NBFC. Now, important point here is to note the treatment of revaluation reserve, which we need to exclude. And this is where the examiner tests your concepts. Now, in this question, paid up share capital is given as rupees 150 lakhs, that is this. Then free reserves are rupees 250 lakhs, that is this. Then CCPS is given as rupees 50 lakhs. Now, on totaling all these, we get rupees 450 lakhs, which are own funds. Now, please note we have omitted the revaluation reserves of rupees 95 lakhs. Thus, the correct option for the given question is option B. The next question is from the topic of Negotiable Instruments Act of Module B. And the question is, which is not an inland instrument? And these answer choices are given to you. That is first option is promissory note made in India plus payable in India plus drawn upon person resident in India. Then second option is promissory note made in India plus payable in India plus drawn upon person resident outside India. Then third option is promissory note made in India plus payable outside India plus drawn upon person resident in India. And last option D is promissory note made in India, payable outside India plus drawn upon person resident outside India. Now friends, for a negotiable instrument to be declared as an inland instrument, it has to satisfy two conditions. First is with respect to place, that is where the instrument is drawn and made payable. Now please note here that promissory note, bills of exchange, checks must be drawn or made in India. Then second condition is with respect to residence of person on whom instrument is drawn. Now for this, promissory notes, bills of exchange and checks must be paid in India or drawn upon a person resident in India. Just remember this table and you will never commit any mistake. Many conceptual questions can be asked in your examination with respect to this concept. So as far as this question is concerned, the correct option is option D. The next question also pertains to Negotiable Instruments Act of Module B of your curriculum. And the question is, negotiable instrument which can be treated as promissory note or bill of exchange is known as, and these options are given to you. That is, first option is inland instrument, then second option is inchoate instrument, then third option is ambiguous instrument, and option D is foreign instrument. Friends, this is a fact-based question, and please remember that an instrument which is vague and cannot be clearly identified either as a bill of exchange or as a promissory note is an ambiguous instrument. In other words, such an instrument may be considered as either promissory note or a bill of exchange. Now, Section 17 of Negotiable Instrument Act provides that a holder may, at his discretion, treat it as either of the two, and the instrument shall thereafter be treated accordingly. But please note, after exercising his option, the holder cannot change it to other kind of instrument. So the correct option for the given question is option C here. The next question is from Types of Companies chapter of Module C of your course curriculum. And the question is, only a natural person who is an Indian citizen and who has stayed in India for a period of at least dash days during the immediately preceding financial year is eligible to incorporate an OPC, that is one person company, and these options are given to you. Friends, this is also a very important question. And please remember, only a natural person who is an Indian citizen, whether resident in India or otherwise, and has stayed in India for a period of not less than 120 days during the immediately preceding financial year is eligible to incorporate a one-person company. Not only this, please remember some other facts as well. That is, same is the condition for the nominee for a sole member of one-person company. Then second is, no minor can become a nominee or member of a one-person company or can hold share with beneficial interest. And last one is, such company cannot carry out non-banking financial investment activities, including investment in securities. But as far as this question is concerned, the correct option is option C here. The next question is from Doctrine of Ultra Vires, which is an important concept of Module C. And the question is, the doctrine which advocates the fact that company cannot act beyond the scope of its memorandum of association is, and these options are given to you. Now friends, I hope you can easily guess the correct option with respect to this question. Yes, the correct option is option C here, that is Doctrine of Ultra Vires. So just remember few more importance about this doctrine. That is, first is, ultra vires literally means beyond the powers. The next is, the opposite of this term is intra vires, which means within powers. The next, when a company or its director violate the provisions of this act or any other law, then such an act is unlawful and attracts penal liability. The next, please remember, the act cannot be ratified even with the consent of all members here. But friends, what is the purpose of this doctrine? So the purpose of the doctrine is twofold. First one is to protect the investors so that they may know for what purpose their money is being employed. And second one is to protect the creditors so that the fund to which they must look for repayment is not dissipated in unauthorized activities. The next question is from the chapter Limited Liability Partnership of your curriculum, and the question is, for the purpose of LLP, resident in India means, and these options are given to you. Now friends, here please understand that a LLP is a new form of legal business entity with limited liability. It is an alternative corporate business vehicle that not only gives the benefit of limited liability at low compliance cost, but also allows its partners the flexibility of organizing their internal structure as a traditional partnership. Also note, the LLP is a single entity, and while the LLP itself is liable for full extent of its assets, the liability of the partners is limited here. Lastly, a person is said to be resident in India if it has stayed in India for a period of not less than 120 days during the previous financial year. Thus the correct option for the given question is option D here. Then next we have a case study from the chapter Directors from module D of your course curriculum, and the case study goes like this. In compliance with Companies Act 2013, at least one woman director must be on the board of the prescribed class or classes of companies. Ms. Mamta is keen to seek the office of woman director in a company. Which of the following companies is mandatorily required to appoint a woman director where Ms. Mamta can hold such office? And these options are given to you. That is, first option is Taj Limited, an unlisted company whose paid up share capital is rupees 150 crores as per the date of last audited financial results. Then second option is Vashi Urban Limited, a listed company whose turnover is 150 crore rupees as per the last date of latest audited financial statements. Then option C is New Bangla Limited, an unlisted company whose turnover is rupees 350 crores as per the last date of the latest audited financial statements. And last option D is all of the above. Friends, please note Rule 3 of Companies Act. This provides that the following classes of companies need to appoint at least one woman director. First is every listed company, that is, if a company is listed, then it must have at least one woman director. Then second class of company is every other public company having first paid up share capital of rupees 100 crores or more, or second point is turnover of 300 crores or more. Also remember, for the purpose of having a woman director on the board, it is clarified that the paid up share capital or turnover as on the last date of audited financial statements shall be taken into account. Now let's see each of the given options one by one. In option A, we have an unlisted company whose paid up share capital is rupees 150 crore rupees as per the last date of latest audited financial statements. So we need to check this second criteria now. Second criteria asks for paid up capital of rupees 100 crores or more, and in our case we have 150 crores. So this company needs to mandatorily have a woman director on its board. So this option is correct here. Then in option B, we have Vashi Urban Limited, a listed company. So this by default needs to have a woman director. So this option is also correct. Lastly, option C says New Bangla Limited, an unlisted company whose turnover is rupees 350 crore rupees. Now this is more than the required 300 crores criteria. So this is also a correct option. Thus, as far as this case study is concerned, the correct option is option D, that is all of the above. The next case scenario is from SARFAESI Act chapter of module B of your course curriculum. And the case study is Mr. Raja Mohan, a farmer, mortgaged his agricultural land and obtained a term loan for cultivation purpose from a nationalized bank. Due to continuous drought, Mr. Raja Mohan could not honor the repayment schedule. Identify whether the bank can initiate action invoking the provisions of SARFAESI Act 2002. And these options are given to you. That is, first option is yes, bank can enforce SARFAESI Act. Then second option B is no, bank can't initiate the act. Then third option C is yes, bank can initiate with district collector's permission. And last option D is no, bank can't initiate the act since Raja Mohan belongs to tribal area. Friends, this case scenario checks the concept of applicability of SARFAESI Act. So please understand that Section 31 of SARFAESI Act 2002 provides the situation in which the provisions of this act are not applicable. Now, one of such situations is any security interest created in agricultural land. And in the present case, security interest is created in agricultural land, hence bank cannot initiate action invoking the provisions of SARFAESI Act in this case. Not even district collector can allow such enforcement of SARFAESI Act. Thus, the correct option for the given question is option B. The next question is from the topic Contracts of Guarantee of Module D. And the question is, A agrees to sell goods to B on guarantee of C for the payment of the price of goods in default of B. The contract of guarantee is valid in which of the following cases? Now case 1 is given as if A is minor, then case 2 is if B is minor, and case 3 is if C is minor. And these answer choices are given to you. Now friends, first of all, you need to know what a contract of guarantee is. So a contract of guarantee is a contract to perform the promise or discharge the liability of a third person in case of his default. Now here please note, the person who gives the guarantee is called surety, the person for whom the guarantee is given is called principal debtor, and the person to whom the guarantee is given is called creditor. Now in our case, three parties involved in the contract of guarantee are, that is in our case, surety, that is person who gives the guarantee, is C. Principal debtor, that is the person in respect of whose default the guarantee is given, that is B. And lastly, creditor, that is person to whom guarantee is given, is A in our case. Now in case 1 of the question, the statement of guarantee is void because the creditor, that is A, is incompetent to contract. Next, in case 2, the agreement of guarantee is valid because the capability of the principal debtor, that is B, does not affect the validity of agreement of the guarantee. Lastly, in case C, the agreement of guarantee is void because the surety, that is C, is incompetent to contract. Thus, the correct option for the given question is option B. The next question is from chapter Contract of Bailment from Module D, and the question is, which of the following constitute a contract of bailment under the provisions of Indian Contract Act 1872? Now first statement is, Arun Banerjee parks his car at a parking lot, locks it and keeps the keys with himself. Then second statement is seizure of goods by customs authorities, and these options are given to you. Friends, as per section 148 of the Contract Act, bailment is the delivery of goods by one person to another for some purpose, and upon a contract, when the purpose is accomplished, be returned or otherwise disposed of according to the directions of the person delivering them. Also remember, for a bailment to exist, the bailer must give possession of bailed property and the bailee must accept it. That is, there must be a transfer in ownership of the goods. Now first case can't be considered as a contract under bailment. Friends, mere custody of goods does not mean possession. In the given case, since keys of the car are with Mr. Banerjee, which means the possession is still with him, and so this can't be considered as a contract of bailment. Then second case can be considered as a valid contract under bailment, since the possession of the goods is transferred to the customs authorities. Therefore, bailment exists here. Thus, the correct option for the given question is option B. Then next is a fact-based question from chapter Contract of Agency of Module D from your course curriculum. And the question is, an agency is terminated. Now these four statements are given to you. That is, first one is by the principal revoking his authority. Statement 2 is by the agent renouncing the business of the agency. Then statement 3 is by the business of the agency being completed. Then statement 4 is by either the principal or agent dying or becoming of unsound mind. And these four answer choices are given to you. Friends, please understand that contract of agency is a relation between an agent and his principal created by an express or implied agreement authorizing an agent by his principal to create contractual relations with the third parties. Now, person so appointed to represent the principal is called as agent, whereas a person who appoints an agent to represent him as per his direction and authority is called as principal. Now, as far as this question is concerned, the correct option for the given question is option D. That is, all the statements given here are correct and all these leads to termination of contract of agency. So friends, finally we have reached the last question of our mock test, and it's from module A and the topic is banking compliance. Now the question is, amalgamation of banking companies requires dash percentage voting of shareholders, and these options are given to you. Friends, please note, amalgamation of banking companies is defined under section 44A of Banking Regulations Act. The procedure for amalgamation of banking companies are given under this section. And as per this section, the scheme of amalgamation, that is terms and conditions of amalgamation, is to be approved by 2/3 majority of the total voting ratios of the shareholders in a general meeting. Thus, the correct option for the given question is option C. Next friends, before winding up, I have a bonus question for you which is from module A, that is Banking Regulation Act. And the question is, according to Banking Regulation Act 1949, no banking company shall pay dividend on its shares until all its, and these options are given to you. First option is depreciation is fully written off. Option B is capitalized expenses have been completely written off. Option C is bad debts are provided in full, and option D is contingent liability is settled. Friends, Section 15 of Banking Regulation Act prohibits every banking company from paying any dividend on its shares until all its capitalized expenses such as preliminary expenses, brokerage and commission on issue of shares, etc. have been completely written off. Also remember, banking company may pay dividend without writing off the following. That is, first, the depreciation in the value of investments in the approved securities, provided such depreciation has not been actually capitalized or accounted for a loss. Then second is the depreciation in the value of its investment in shares, debentures and bonds, etc., where adequate provision have been made for such depreciation. Then third is the bad debts where adequate provisions have been made in this behalf, and the auditor of banking company should approve such provision. And lastly, please note, bank can pay dividends after taking specific approval from Reserve Bank of India. Thus, the correct option for the given question is option B here. Friends, with this I wind up this mock test. I hope you got a lot of concept clarity and how the questions and case studies can come in your examination. Lastly, don't forget to get your CAIIB resources from the links given in description to this video. So thank you and all the best for your coming examination. Last but not the least, don't forget to comment on this video if you find the video useful. Just write useful in the comment section. This will make me know that you are loving the content and I will make sure that I come up with more such videos.